Hello, it's Jeffrey Christian of CPM Group. It's just afternoon on Friday, the 20th of January here in New York. I want to talk about silver inventories some more. We did a video on Tuesday on silver inventories. We had two charts. One was total reported and estimated silver bullion in bullion and bullion coin form. And the other one had to do with the relationship between open interest on the Comex and silver prices and inventories, and the idea that low inventories on the futures exchange do not necessarily presage higher silver prices. There's a variety of reasons about that. And I want to expand on the comments that we made on Tuesday about silver inventories. Some of the comments that we received after that video suggested I was not necessarily thorough enough in my explanations of how silver inventories function in the silver market, at least for some viewers. So we want to try to elaborate that. And we do realize that there are some people who we tend to go fast, and we know this stuff. We live it day in, day out, and so we sometimes are more shorthanded in talking about things than we should be for people who don't live and breathe commodities research. And I understand there are other people who will not believe anything we say anyway, and that's their issues. I had wanted to talk about emerging central banks' gold holdings, their policies, and their practices. There have been some egregiously inaccurate things being said about the emerging market governments, the BRICS and others, gold policies, and that's just going to have to wait. I think that we want to focus on silver inventories while we're on the subject, and that goes to something that I just sort of want to reiterate. Why does CPM Group make these videos and post up a lot of information that's free? And the primary reason is to educate the public and to possibly elevate the level of discourse in the public about precious metals and commodities. There's a tremendous amount of misinformation and bad understanding about commodities and precious metals. And we've dedicated our lives and careers to addressing this with quality data and analysis. Second reason that we're doing it is to memorialize our institutional knowledge of precious metals and commodities. We have a tremendous amount of information within CPM Group. There are people in the precious metals industry who talk about CPM Group as the institutional historical record for precious metals, simply because we do have all of this information, and we can, and from time to time do, explain to companies and industry associations and others the history of their own operations that they don't necessarily have because their executives and employees have cycled through while we've been mired in the precious metals markets all these years. And the third reason, to be very honest, is to market CPM Group. We have superior statistics, superior research, and superior analysis. Our track records show that. We've been around since the 70s doing precious metals and other commodities research, and people ought to make themselves, they should avail themselves to our information. They'll do better in their investments. So this was the first chart that I used, and it shows total refined silver bullion inventories. And we talked about what they mean. And some of the people looked at it and they didn't quite understand the ebb and flow of this. This is the amount of silver bullion, and the green part is bullion coins, that exists in the world. And you can see it fluctuates. It got down to around 3,700,000,000 ounces around 2005 or 2006. It's up around 5.5 billion now. It was around 5.5 billion in 1990, 1991. It ebbs and flows. There's amounts of silver that come into the world as refined metal through mine production. You have to be very careful with secondary recovery from scrap, because That's a do loop there. It's not necessarily adding to the total amount of silver that has been mined through history and is existent in various forms in the world. But it's the amount of silver that comes into the world and gets refined into bullion, less stuff that's being used and fabricated and manufactured products. So it's there in bullion form, ready to be sold as silver. And the blue part is this gigantic amount of implied unreported stocks. I won't bore you with the details about how those numbers come out. And you see this goes back to 1970. In our silver yearbook, I believe we actually have the data back to 1950. It's information that predates my involvement in the history of silver market research. But you could see that back in the 70s and 80s, the bulk of silver in refined form was held in unreported inventories. That changed for a couple of reasons. The gray part at the bottom you can see are ETFs, exchange traded funds, holdings of physical silver. This is not paper silver. These are not, and the orange part is exchange metal that's registered or eligible and reported as being in depositories in New York, Mumbai, Shanghai, and other places where there are exchanges. We have London in there now since 2016, when the London banking industry and depositories started reporting their data. But this is physical metal. These aren't shares of ETFs or futures or options contracts. This is physical metal. And you can see really with the start of silver ETFs around 2005, 2007, we've seen close to 1 billion ounces. Sometimes it's over 1 billion, sometimes it's a little under 1 billion ounces of silver going into ETFs, physical silver. And the green part at the top are coins, bullion coins. The Canadian Maple Leaf and the U.S. Eagle were started in the mid-'80s. CPM Group, or I personally were involved in helping to create both of those coin programs as well as other coin programs. We're very proud of that. And other coin programs came along afterward. And you've seen since the 1980s a shift away from bullion holdings to bullion coins. And then since 2005, a shift away from bullion holdings to ETFs. And there are a variety of reasons for that. One is that as the price of silver rose after 2005, a 1,000-ounce bar was worth $5,000 in 2005. Now today, the price is around $23 an ounce, so that's a $23,000 bar. If you try to sell a $23,000 bar, the company to whom you sell it to is supposed to report that purchase to the IRS. So a lot of people have swapped 1,000-ounce bars since the price of silver got over $10,000. That was the threshold, at least in the United States. It varies from jurisdiction to jurisdiction. Some jurisdictions don't have anything. But in the United States, it's over $10,000. Get reported that you've sold that, and the IRS is going to be looking for a payment of your capital gains tax. So a lot of people have swapped 1,000-ounce bars for coins. They take less than 1,000 ounces in silver coins because the silver coins have a premium because they're 1 ounce and they're manufactured. And then they can sell those coins off in units less than $10,000 and avoid having taxes reported on that. Also, ETFs are just more convenient to hold your metal than 1,000-ounce bars. We've had a lot of clients who have personally bought 1,000-ounce bars in the 80s and 90s and early aughties, and there's an issue with storing them. ETFs, they're there. You can sell them in smaller increments, or buy them in smaller increments. They're just more facile. So what you see is a shift in the way people hold silver. And the fact that even at the low point in 2005, they still had more than $3.5 trillion or ounces of silver. Now, you can see it was falling a little bit in the 1970s. We had a supply deficit back then, a primary deficit in that mine production and secondary recovery of refined metal on an annual basis was less than fabrication demand. So every year, industry bought silver from people who were holding it in bullion form and melted it down and made it into products. That shifted in 1980 when the price of silver went from $5 to $50. There were a lot of investors who said, wow. And then it came back down the next day. You know, by April, it was $16 an ounce. And then it fell and fell and fell. And people said, okay, it went from $5 to $50, came back down to $16. I'm going to buy it at 16 because it's going back up to 50. Or somebody told me it's going to 100. And from 1980 until 1989, investors were net buyers of silver in bullion form. They started selling that around 1989, 1990. And you saw this long period of decline from 1990 until 2005, when investors and others who were holding silver bullion were net sellers. And the price of silver was trading between $3.50 and $5.50 an ounce for most of that period of time. And industry was using more and more silver, electronics and jewelry and a host of other applications. 2005, that shifted, and investors started buying more silver. And you can see here, they tended to buy it in ETFs and in coins more than in bullion bars. So that's what this data shows you. It's the ebb and flow of physical metal, no paper involved, and the preferences that have shifted toward coins and ETFs over the years. And the fact that there is a lot of silver out there that's readily saleable as silver because it's in refined bullion form, either as bars, or coins, or medallions, or other refined silver products. Now, I want to get into the more interesting things, and this is going to be a longer chart. Why falling Comex inventories do not cause silver prices to rise. These are Comex inventories. The orange part is the eligible in Comex registered depositories that's not registered with the Comex. And the blue part is actually registered with the Comex. You can see an ebb and a flow. I'll show you more charts with this. And we'll compare that to the price. This is the other chart I used on Tuesday. It's Comex open interest versus deliveries. And it's very important to understand that most Comex investors prefer cash profits to physical metal. 90+% of the people, 95% of the silver isn't taken delivery of. These are people who are buying and seeking and buying price exposure, not physical metal. So the important thing is not what are the inventories versus deliveries, and is the Comex going to run out of silver? It's the open interest versus deliveries. And the vast majority of open interest doesn't represent people who want silver. It represents people who want exposure to silver. The open interest represents commercial hedging, commercial companies, from producers to smelters to refiners to fabricators of all sorts to manufacturers to companies that have silver in inventories, companies that sell silver to investors, and jewelry companies. We have jewelry companies that will hedge the silver and gold content of their jewelry that they have in inventories until they sell it. And those commercials want to lay off their price exposure to investors. They want to make money by selling their products. And they want to protect their company's financial stability from the fluctuations in silver prices. So they want to lay off their price exposure to investors. And then investors want to buy that price exposure to invest or speculate in it, in silver or other commodities. There are a few people investors who want to pay more than they have to and buy their physical metal through the Comex futures. I'll buy a futures exchange contract, I'll stand for delivery, I'll pay full price, and then I'll arrange to take delivery of that, either leaving it in the depository or actually taking it out and paying an outage charge to the depository to take physical delivery of the bar. And that happens all the time. Every day there are hundreds of thousands of ounces of silver that come into and out of those inventories. Most of that is actually producers, refiners, and users, fabricators, but some of it is investors. It doesn't take weeks and months. It doesn't take four people who don't know what they're talking about weeks or months to take delivery. It happens every day. It's a very simple process. But most investors that get involved in futures don't want physical metal. They want the price exposure. So they don't take delivery, and therefore the relationship between deliveries and open interest is very low. And here you can see, it's generally speaking less than 5%. Back in the 80s and 90s, it was 10, 20%. But the way industry uses its silver and the way it hedges and protects its price exposure has changed. So it's less now than it used to be. Some really interesting stuff that I came up with for this, so bear with me. Lower falling inventories don't push prices higher. You keep hearing, we're going to drain the Comex of inventories and then the price will skyrocket. But you can see back in the 90s, Comex inventories fell sharply from like 280 million ounces down to less than 100 million ounces, about 70, 75 million ounces. And while inventories fell that much, figure out the percentage change, the price of silver was flat between $3.50 and $5.50. Go forward and take a look from 2012 to 2020, and you can see inventories rose very sharply, and the silver price actually rose both at the beginning of that period of time and at the end of that time. The relationship between Comex inventories and prices is not negative. It's actually kind of positive. And the idea that rising prices actually tend to correspond with rising inventories and falling prices or flat prices tend to correspond with falling inventories lies in the face. It just says right off the bat, people who are telling you, hey, take delivery of Comex, drain Comex inventories and we'll drive the price higher, they don't know what they're talking about. Or they do, and they're purposefully misleading you. I know some in each camp. Now, the same is true if you only look at registered inventories. It's the same sort of thing. You can see registered inventories fell sharply in the 90s, didn't do anything for the price of silver. Registered inventories started rising around 2002. They started rising from 2002 to 2008. Prices rose very sharply. 2005 to 2011, prices came down, inventories came down, inventories rose, prices rose, inventories fell, prices fell. I'm sorry. But here's the interesting stuff. Investors only worry about too low of silver inventories. Now, the top part is you can see the Comex open interest, and then you can see registered and eligible inventories, registered in total, which includes the eligible. And you can see silver, you've got about 5%, and we just took one day. This was 2 days ago, so, January 18th. 5% of open interest was covered by inventories, registered inventories, and total inventories covered about 44% of silver. And you hear these people say all the time that, silver inventories are running out and that's going to push the price higher. Now, gold's a special thing. And here you see 22%, 47%. But look at platinum and palladium, 3%, 5%, 5%, 6%. registered inventories relationship with open interest in platinum and palladium is roughly in line with that of silver. And the cover of total, including not only registered but eligible, is a fraction of what it is in silver. And yet you don't hear snake oil salesmen say, hey, we're running out of platinum and palladium on the Comex and it's going to drive the price higher. But it gets even better. Compare it to base metals, and we looked at LME because that's where most base metals are traded. And again, 5% of inventories, open interest is covered by registered stocks. And the LME, we just looked at the LME registered warehouse stocks. We did not look at total global stocks. But again, you can see copper, one of the most important and traded metals in the world, 1%. Aluminum, 2.6%, 0.3% for zinc, 0.7%, 0.8% for tin, fraction of the coverage in silver. And yet no one sits around saying, oh my God, the price is going to skyrocket because there's not enough metal registered with the futures exchange. And then we went and we said, well, what about agricultural and energy futures? And we said, what about, well, okay, let's look at oil, the most traded commodity in the world. And let's look at corn, one of the biggest agricultural futures markets and physical corn market in the world. And it was really weird because it seems that in energy and agricultural futures, there aren't registered inventories. NYMEX, which trades oil, says, okay, we're going to trade oil for delivery in Cushing, West Texas Intermediate. They also have a Brent contract, but I just looked at Cushing. This is the capacity, this is the amount of oil 2 days ago, or 3 days, 13th, I think it was. This is the amount of oil in Cushing. It's not registered with the NYMEX. It's there. It's available for delivery. And it's 0.2%. Corn, Chicago Board of Trade, which is actually part of this CME group along with Comex and NYMEX, same thing. Here's the amount of corn that is in grain elevators in 6 major delivery points, and it's 0.35% of the open interest. Because again, the futures markets are places where people seek to lay off and hedge their price exposure, and others seek to buy price exposure. They're not necessarily seeking oil, and they're not necessarily seeking corn or anything else. Which leads us to a really interesting conclusion. And I'm sorry I've gone so long. Why is it that would-be silver investors are so worried about there not being enough silver to cover open interest on the Comex? Why do they think that these low silver inventories relative to open interest means that the silver price will rise sharply, even though this relationship has not yielded such a price increase for more than half a century? They don't worry about it in other markets. They don't even have registered inventories in most futures markets. And it's just not an issue. But in the silver market, you see all these people spending all this time saying all this. And why do they do it? Because they've been lied to and they've been misled for decades. You can read a part of it from 1989 at CPM Group's website. Here's the link to a letter written to the then Attorney General of the United States about how there was bad behavior on the Comex, and if the government would just crack down and the CFT would do its job, the price of silver would rise. And the CFT studied it. They studied it several times, and they never found anything to substantiate any of that. Sounds kind of familiar. Fake news. That's what I got today. I'm sorry I took long, but it's something that investors in silver and other metals really ought to know about. You can get on the right side of the market buy our yearbooks. You can pre-order them now on our website. You can become a retail investor client of ours, or you can become a major client of ours if you have the price exposure and the desire to really get into the nitty-gritty of understanding these markets that you invest in. You can also get a lot of other free reads at our website. I'll see you next week. Take care. Take care of yourself. Take care of the ones around you. And try to help the whole world, because the whole world needs a lot of help. Goodbye.